The first myth involves, are the Fed's actions creating a possible hyperinflation? That's not very likely. We look at the data, which shows that the latest inflation data from the U.S. actually shows that the core inflation rate, which is the important one, is actually slowing down. Gold prices have come down, and the trade-weighted dollar has gotten a bit stronger. So all of those are inconsistent with the idea that we're headed for higher inflation. The second myth is the idea that a gold standard would help. The U.S. in effect had a gold standard after World War II, where the dollar was linked to gold at $35 an ounce. That actually encouraged inflows of funds to the United States that were inflationary. And when the inflation threatened to bite and countries tried to force the U.S. to follow the standards of the gold standard, the U.S. With the famous Nixon shock in August of 1971 actually abandoned the gold standard. The other myth is that the Fed's policy is making it easier for the federal government to run larger budget deficits. If that were the case, we'd be seeing the Fed directly funding government spending, which they're not. The Fed is actually adding to the reserves of the banking system, and the banking system is choosing not to use those reserves aggressively in pursuing purchases of assets, so that we're really effectively in a liquidity trap. And in a case like that, it's very difficult for the central bank to expedite financing of government deficits, and actually sometimes it's very difficult for the Fed to create any stimulus at all. The critics of the Fed suggest the Fed actually ought to tighten by withdrawing reserves from the system or by increasing interest rates. I think right now the Fed needs to sit tight and be alert for the possibility that if the economy slows further, they may actually, if they monitor the price level and we see a deflation threat, they may need to ease again.